If you're looking for the most effective strategies to trade price action, I want your full attention, because I'm about to reveal my most important tactics after over 10 years of price action trading. We're not going to talk about support and resistance, candlestick patterns or chart patterns. I will share something more important: how to read price action momentum and how to decode the market rhythm. And if you want to show support, please leave a like to help us with YouTube algorithm and turn on the bell so you don't miss when new videos are released. Traders often have this big obstacle. They aren't able to recognize if the market today is trending or ranging. Here's your first lesson. The moment you recognize what type of day you are dealing with, then you can apply the appropriate methods for trading. If it's trending, pullbacks are the best choices. It doesn't matter whether it's the first or the second pullback, a one-bar pullback or a complex pullback. If it's a trading range day, you only enter at the extremes of the range, wait for a clear confirmation, and stay out of the middle because it can be very choppy. In order to read the market and to evaluate the price momentum, I use price action. The main reason I prefer price action instead of employing indicators is that indicators will lose their powers when the market is not trending. They create all kinds of false signals on a range day. That is a big problem because market is rotating in sideways motion over 70% of the time. One thing I discovered through many years of trading is that trading ranges is surprisingly predictable. The reason behind this is because the market is in a zone of fair value of price, where the buyers and sellers are somewhat passive. Here are several strategies which can help you to potentially tell what type of day is ahead. First, we'll talk about price action during trending days. So number 1, strength and follow-ups. On a trending day, whether it's an uptrend or a downtrend, the bar which initiate the trend usually have decent follow-ups. Market has a rhythm like music. You can sense the urgency in tempo and strength behind every bar when it's forming. One side is dominating the other one, and this should be fairly obvious. In a strong uptrend, the chart is filled with green trend bars, with average size body but closed high. Bars are slowly moving upwards, which can create a parabolic curve. Any pullback red bar is short-lived, with narrow body and long wicks at the bottom. At a glance, they are just simply more green bars than red bars. When a strong uptrend is in progress, it's very hard to make money selling, but for buyers, you should see profit not long after you entered. The price is pushed up and nobody is taking profit until it reaches a fairly strong supply zone. Any counter-trend attempt will fail and becomes the most reliable setup to resume the trend. The wick of the candle is very important in price action trading. It shows both rejection and strength. It's the hidden truth about domination. In an uptrend, you should see long wicks at the bottom of the bars, not on top. It means any selling is being rejected and pushed up. The same principles apply for downtrend. More consecutive red bars with average size body and wicks on top of the bars. Any green bar pullback is small and short-lived. Here we have a very strong downtrend. There are few green bars and many bearish bars. The close of each candle is lower than the previous close. It's in a parabolic curve rather than boxed in. In a trending day, a market controlled by bulls is often characterized by the following bar patterns. First, the obvious one is that we have more bull bars than bear bars. When we see this on our charts, this means that the bulls have more power and are increasingly moving the market upwards. Also, we will see consecutive bull bars. Consecutive bull bars is a clear indication of a bullish momentum. In a bull market, the green bodies are bigger than the red bodies. When we see this on our charts, that's a signal that the bulls have more strength than the bears. Also, during a bull-controlled market, we will see the green bars closing near their highs. This suggests a good momentum to the upside, because the bulls are trying to maintain the prices higher. We will also see a lot of wicks below the green bars. This also represents a good signal that the bulls are in control of the market, and that they are trying to push the prices upwards. When we see the green bodies getting bigger, this signals a clear bullish momentum. Number 2. The old school higher high and lower low. First, The follow-up bars should be breaking out previous bars. For example, each follow-up green bar in an uptrend should have higher low, higher high, and higher close to the previous one. Vice versa for the downtrend. Red bearish bars should be making lower low, lower high, and lower close than the previous bar. Another interpretation is based on the structural pattern, the pivot point on each swing. Price never moves in a straight line, it moves in waves, and each wave will create a pivot point on the chart. These pivot points can often be found in pullbacks of a trend. They are important turning points, which represent zones of demand and supply. The best way to use these pivot points to identify the trend is to create a trend line by connecting them with straight lines. You don't need advanced knowledge to draw complex trend lines. Just connect a low and a higher low and you get a simple trend line pointing in an up direction. For a downtrend, connect any high and a lower high. This trend line gives you both the direction of the trend and a great reference point for support and resistance for future price movement. Number 3. The dynamic support and resistance tool, namely the exponential moving average. I personally use the 20-period exponential moving average on my chart when trading price action because it reacts to price quickly and follows the price action closely. There are many ways of using the EMA, but I found two methods are quite effective. First, I use the 20-period EMA to give me a broad idea of what to expect from the day, whether it's trending or ranging. For trending days, bars usually stay consistently above or below one side of the EMA, most of the time not touching the EMA for hours until a deep correction. For range day, it's very obvious that price interacts with the EMA very closely. Another usage for the EMA is to watch the price action around the EMA when it's touched, and based on the reaction, you find tradable setups. The EMA isn't like a trend line, a straight line. The EMA follows the price, and it serves as a strong support and resistance reference point. But it only works best when price is trending in one direction. When price moves sideways, the EMA loses its efficiency and doesn't produce any reliable setups. As long as the price stays above the EMA, you will only buy, never sell. The opposite is true for downtrend. One of the trade models I employ often is to enter the first deep pullback. In a strong trend, price goes too far away from the EMA and not touching for hours. But when it does for the first time, this deep pullback is a very reliable setup to resume the original trend. Some experts call the EMA the mean. When the price moves too far away from the mean, it can create a rubber band effect, and price would stretch back to the EMA. Traders watching for the EMA know that the probability of the first pullback of a strong trend to turn into a reversal is quite rare. So when price returns to the EMA, they would enter hoping the original trend will resume. Now let's talk about the trading range, the sideways price action. Trading ranges can be very tricky because it's very difficult to distinguish between range and trend. It's understandable because they have some similarities. The relationship between trend and range is that they are interactive. One can survive without the other. Trend is essentially a breakout phase. Range is essentially a consolidation phase. And market is rotating between trend and range. So how do you actually read a price action range? Let's talk about wicks. Trading range is filled with wicks, especially more on top and bottom of the approximate range parameter. The reason behind this is back-to-back failure. When price is being pushed up to the upper boundary of the range, sellers are letting it go to see how far the price can go. The higher it goes, the more profit for sellers when they sell into it. It creates a vacuum effect. When price becomes excessive, sellers will jump in and sell into buyers, pushing the price towards the lower boundary of the range. Entering at the extremes offers great risk-to-reward ratio for traders. You should try to embrace range days because they are somewhat predictable. And the first step, look for many long wicks around the edges of the ranges. Wicks are failures. Top wicks means buyers failed, and bottom wicks means sellers failed. Remember this. Range will have multiple failed breakout attempts before a real breakout. When the real breakout occurs, you can't miss it because it's convincing both in volume and bar size. Any inferior breakout will fail within a short time, generally within 5 bars. Look at the wicks within this range. Observe this area filled with dojis and bars that are overlapping. This bar shows the real breakout of the range. The bar is forceful, large in size, closed high, and with a minimal wick. Number 2. Alternation between bullish and bearish trend. This shows both sides are active. There is no feeling of continuation of either side. There is no consistency in strength. The red bars and green bars are somewhat equal in quantity. The strength is weak. It shines and dies very quickly. Often, you will see a gigantic bar in a range. It will take over the whole space. Then, the follow-up is on the opposite side, so no momentum continuation. And traders trying to trade the first bar are now trapped. Price moved in the opposite direction. Again, there is no sense of consistency. Range days can create a weird feeling that market is not really active, and it feels lazy. But actually, both sides are very active. It creates a balance between buyers and sellers. That's why the price is not breaking out to any one direction. All the setups which worked best in trend trading are now losing their magical power. Remember this when trading ranges. Patience. Wait for confirmation and proof one side is actually failing. Then enter at the extremes. Number 3. Dojis and overlapping price action. When you start to see a lot of dojis and bars are overlapping, market is probably ranging. The dojis are the early signs for range formations. A doji is a 1-bar trading range in essence, and it has many variations. The gravestone, the dragonfly, the hammer, the hanging man. The names are not so important. They are all indicating the same character, indecisiveness. Overlapping price action simply means the size of the bars are either similar or inside of each other. Price is moving sideways, is not going anywhere. Sometimes you will see 2 or more bars having the same high or low. Then you look to the left and you will find past corresponding price action that stopped at that level also. This means there is a strong supply or demand zone for that level. So whenever you see 2 or more bars have the same high or low, mark that level and watch for a reaction when price revisits that level. Look for reliable setups of real breakout or failed breakout. Number 4. The 20 EMA. When price is trending strong and fast, it's hard for the EMA to catch up with the price. Therefore, in a strong trend, there's a distance between the EMA and the bars. In trending ranges, it's the opposite. There's a lot of touching. Because price movement in a range is not very volatile, most of the time is not going anywhere. The EMA cuts through the range, often in the middle. The 20-period EMA is like an axis where price is moving around it. There is one scenario to note here. When a range is about to break, watch the price action closely and you will notice the EMA is somehow holding the bars and push them to the breakout direction. For an upside breakout, the price will stop around the middle of the range, around the EMA. Vice versa for the downtrend. Price will test the EMA and will be pushed to the downside. Being able to read a price action chart is important to make the right decisions. The problem many traders have is that they overcomplicate things and get easily confused, or they don't have a process in the first place and don't know what they are looking for. Now, your job is to open your trading platform, choose one market, and start analyzing price action using these techniques. Just this. I could have mentioned chart patterns like flags or triangles, but these are just ranges. Or I could have mentioned tens of candlestick patterns like inside bars or piercing lines, but again, these aren't as important right now. What's important is to decode the market rhythm, to distinguish a trend day from a range day, and to read price momentum. This is the best price action approach. As always, if you got any value from this and learned something new, Leave us a like to help us with YouTube algorithm, and also make sure to enable notifications to stay in touch when new videos are released. Until next time.